and looking at a ton of deals is so important, because it's so important to know what makes a good deal and or doesn't. Don't get me wrong, you guys, not every deal that comes across my inbox is a good deal. Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Catani, and happy hump day it is. It's Wednesday, everybody. We are officially halfway through the week. Hope everyone's week is going very well. A lot of big things happening here, getting a lot of interest in this oil and gas deal. And it's been amazing. Obviously there's a lot of capital sitting on the sidelines, especially in the real estate game, for obvious reasons. I've talked about it here on the podcast, where people are just kind of waiting to see. It's kind of a stagnant moment in the cycle where, we're not sure what's going to happen with interest rates. Obviously, the Fed laid out a plan, and really they're sticking to the plan. Personally, I think it's still been pretty predictable, but really the biggest concern, I think, on that sense economically is what kind of rate hike is coming next. Personally, I believe it's another 25 basis point hike. That's kind of what they've indicated. That will put them in the range that they were shooting for last year when they began rate hikes, right in that 5 to 5.25% range. But, obviously a lot of real estate starting to feel it. You obviously have, the transaction volume in the residential space has fallen significantly. The average median home price has dropped as well. I know here in Utah, prices have come down and are kind of sitting flat. Not to say that transactions aren't still happening, just not at the same volume. And as an investor, you typically like to know one way or the other, right? Whether the market's going to continue to drop or continue to move up. Now, I know I've said that shouldn't scare you, and that, you can cost basis, kind of average dollar, right? Where basically you just keep buying, and some are going to be a little bit high, some are going to be a little bit low. The nice thing with real estate is, there are still good deals, right? This is just your kind of top, what everybody sees, what pops to the surface, kind of MLS type stuff that the mainstream media is. But there are still good deals out there, absolutely, and you'll know them when you find them. And what's really started to happen, which I love, is a lot of creative financing, a lot more transactions happening with seller financing, even on the commercial side, in like larger apartment complexes. People are getting creative. And, if you can get creative and both sides agree to it and makes a deal work, then it's a great deal. Now, one thing I will say as a caveat to seller financing, don't let that, just because seller financing is an option, don't mistake that for a good deal, right? You still need to get the right terms. It was actually put very well by Cody Sanchez. If you follow her, she's a great follow. She buys what she calls boring businesses, laundromats, smaller car washes, little vending machines, businesses like that. And so what she says is she'll either agree to your price or your terms, but not both. So if it's your price, then it has to be her terms. If it's her, so if you want your price, then it's going to be on her terms. If, you're willing to go to her price, then she'll agree to your terms. And that's not a blanket statement, of course, but for the most part, that's really something to think about. So when seller financing is available, a lot of times what will happen is seller financing is available and the seller will be like, "Hey, these are my terms, right? Here's my price, down payment, amortization schedule, balloon, interest rate, all of the things." But what's really important when you're looking at seller financing is you should still be negotiating, right? Just because it's seller financing doesn't make it, some incredible deal, right? It could still be bad debt terms. And so it's important to still negotiate those. So, but my whole point here to come full circle is to say that, talking to investors, they're, even some operators, because like I had said before, is a lot of operators are passive investors. And in fact, most of them are. And they're having a hard time finding deals that work. Now, what's starting to happen more and more is you're starting to see more deals in hot water. And so, you're starting to get some kind of just some distressed sellers, not distressed assets, although sometimes they're not mutually exclusive, although they can be symbiotic in the sense of, what really is causing one of the bigger issues is what happened is a lot of operators bought because there was transaction volume was so high. There were a lot of people selling because the market was on fire. You had a lot of groups get in over their head in the sense of they scaled too quickly. So all of a sudden, they have a 500 unit portfolio and it's still 3 guys and they didn't hire an asset manager and, there's, they don't have property management, in-house. So they've got third-party property management and they don't really know what they're doing. And they take on these like larger assets. And you may be wondering, well, why didn't lenders lend to them? Well, because when you have, let's say you already have let's say you have a 350 unit portfolio and everything looks good, because what was happening is it was really easy to look good with the market conditions, meaning, the average rents were increasing. I think the national average from like 21 to 22 was, even at the end of 20. So yeah, for all of 2022 and all of 2023, the national average was like 12% increase. So when the market conditions are making you look good as an operator, meaning you didn't really do anything, it's just rents are just increasing and, occupancy is super low. It's easy to, as a lender, and lenders want to lend. I mean, they want to be in on this action, and not to say that they're not still underwriting and they're being conservative, but, if you can get in on a deal, so let's say you have a 350 unit apartment or 350 unit portfolio and, you're 10 months into it and you've already hit pro forma, that's going to look incredible to a lender, right? And to them, certainly they're lending on your 5-year plan. But in 2022, no one could have foreseen, in 2021, sorry, I meant 2021 and 2020. Yeah, I said that. In 2021, no one could have foreseen that interest rates were going to go up as quickly as they did, even lenders, right? And they're on the front lines of that. So what was happening is, you got 350 units in your portfolio and you want to go buy a 150 unit apartment complex. To them, it looks like you've got the infrastructure in place because you're already nailing your pro formas and everything's going according to plan on the other 350 units. Right. And, this is the same lender. They've lended to you before. They see that you're doing well, right? Because that's what you're typically doing. is once you find a good lender, you're typically going to them first. And most likely in those days, you were just going to them, right? Because they wanted to help you get the deal done. So what's happening now is those groups are in over their head because they didn't buy rate caps and they did like all bridge debt and it was all floating rate. And now they can't make cap rates work, right? Because all of a sudden they got an 8% interest rate, their debt service drops below 1 and they're toast. So I just got this deal in my email. It's from Open Door Capital. That's Brandon Turner's group. Shout out to Brandon Turner. Really excited because, should I say it? I'm going to say it. I don't think I've announced this yet. Ooh, I kind of wanted it to be a surprise. We have someone from Open Door. It's not Brandon. I will say this. It's not Brandon, but we have someone high up at Open Door Capital coming to be a guest on the show. Very, very excited. I do believe that might actually be, let's see. No, I think it's actually, okay. So it's only a couple weeks away. So I'm very, very excited. So I have this deal come across and we'll kind of break this down. I think this will be a good one. And I still have another topic to talk about, but I got to do a show for Thursday too. So we'll save it for that. Let's see. So Open Door Capital. So this is what they're calling the Texas 3-pack. I love that. It's 637 units, 3 apartment locations across the Austin and Houston MSAs. It's a 5 to 10 year hold, 15 to 18% average annual return. That's silly numbers in this current environment. But here's why. They're able to assume the loan. This is how distressed this group, the seller must be, because they're able to assume so it's already a $24 million discount that they're purchasing this at, which is silly. Assuming a fixed rate, 3.8% interest rate, which means this was purchased back in. What's wild about this one is this is a fixed rate, meaning they're assuming an agency 10-year debt loan and they're getting 7 years. So this is interesting to me. I'd love to talk to a lender about this, get more clarification. I don't know if this is a typo. They're assuming a 7 years interest only. I don't know that I've ever seen a 10-year fixed rate, 10-year interest only. That must have been in negotiated terms with the lender. I wonder if Open Door Capital negotiated the 7-year part. Because when you assume the loan, there's still some things you got to work out with the lender. The lender has to be okay with it, of course. So there's typically still some negotiation that happens. And I wonder if they're also doing it at a 61% LTV. It's just, that is silly low LTV, you guys. That's like, I mean, that means they're bringing 39% equity. They don't have, let's see, selling due to distress. Yeah, I saw these trends happening 6 months ago. I mean, no offense, we all did, but okay. So these specific properties are not distressed. The seller is being forced to liquidate to free up capital to triage other properties that are under distress. So there you go. Pretty common. That's happening, going to keep happening over the next 12 to 18 months, and possibly even longer. Could go into 2025. Extremely conservative. Supposedly they've turned down over 700 plus deals, holding out for a slam dunk. So they've been holding out for distress. So basically distressed sellers, like I was saying, distressed sellers, not distressed properties, which is huge. Okay. So, oh, wow. So the portfolio was originally listed in 2022 you guys should get on their list, by the way. Because again, like this is going to be a webinar. I'm not going to be able to invest in this deal or raise capital for this deal, but this is a webinar I'll watch, right? This goes back to what I was saying yesterday about webinars. Like these are so important to look at these deals and analyze these deals and understand what makes this a good deal. Here's a key point right here. Portfolio was originally listed last year for 135 million. Now have it under contract for 111 million, $24 million discount relative to the pricing 12 months ago. 12 months ago. Yeah. Okay. So 12 months ago, So 12 months ago, interest rates were just starting to go up. So interesting. Yeah. So a really good point today. In most cases today, a discount basis such as this would be somewhat of a wash in the short term as it offset by higher interest rates, which is very true, which is why transaction volume is very low. Now, typically, now we are heading into the spring season and things will start to pick up. And I was having this conversation with another Raise Master the other day. Shout out to my boy Sam. And we were talking about how Q3 is going to explode in commercial real estate. Like, I really think people are going to have a better idea of what's going to be happening over the next 12 to 18 months. And so you'll start to see people really start to make moves, especially those who've been sitting for, people have been sitting for 6-12 months on the sidelines. Yeah. So, okay. So they're able to assume the existing low interest rate. Interesting. Okay. Okay. So, yeah. And then these are close quarters. So two of them are right near their headquarters in Houston. Disrupt Equity, that must be a partner of theirs on this deal, would be my guess. So that makes that very attractive, right? I mean, literally 10 minutes from their headquarters. And then the third is only 5 minutes from two of our Austin assets. So that makes your cost when it comes to property management, so low, because you're not, you don't have to bring in another regional manager. You're just adding this or deep market knowledge and established property management teams in these cities will allow us to hit the ground running, right? So it's things like this. So this is a great dissection to look at this and be like, okay, why is this a good deal? Well, they get to assume a 3.8% interest rate when right now it'd probably cost them 6.5% to 7%, right? That would basically kill your 24 million. That's a difference of, let's even just say 3% over, my phone is charging. Hang on, let me pull my calculator. So on the debt side, 61, I can't believe they're going 61%. That is so crazy to me. Yeah, so 3%. Yeah, so that's $3.3 million right there, just on the cost, 111 million, right? So that obviously eats away from, and that's just the debt portion. That's just 3% of the debt. That's not even like the total cost, right? Amortization, principal, blah, blah, blah. So, man, and they're coming in 60. So this is a really awesome dissection because now you get to understand, obviously this is a large group, this is going to put them over close to the billion mark for sure. But, they've got close to $1 billion under management. I think it's like 700 something million. So this will get them that much closer. So this just goes off what I said yesterday with webinars. This is why being on a ton of lists and looking at a ton of deals is so important, because it's so important to know what makes a good deal and or doesn't. Don't get me wrong, you guys, not every deal that comes across my inbox is a good deal. There are deals where I look at them and you look at these debt structures and, people talk in this industry too. So a lot of times a deal will come across and people will be like, man, I looked at this deal and passed up on it because of X, Y, and Z. I can't believe they're taking it down. Not sure how they're making it work. which means when you hear an operator say, not sure how they're making it work because we couldn't, that typically means that they were aggressive in some portion of their underwriting, whether it's most commonly, I don't want to say most commonly because be too general a statement. There are a few common areas. One is they think that they can bring expenses down, like a lot farther down. And in some cases you can. This is a perfect example of being able to keep your costs low, is when the assets are right in the vicinity of assets you're already managing. So that makes it a very cost-effective acquisition because you're not adding a ton of new expenses in the ways of property management. So expenses are a big one with property management being in there. Also being able to reduce operating expenses, maybe RUBS, which means, basically charging back the utilities. So that's a big one. Also, what they think they can get for market rent is another common one, pushing. So for me, right now in a conservative state, I start with 3%. My assumption is 3% growth. I might go up to 5% just to see, depending on the market. In Salt Lake, I might go up to 5% depending on where it is. This year, I wouldn't go past, I would never go past 5% and consider it conservative underwriting. Over 5%, you're no longer being conservative. So that's a really good key metric for you guys to pay attention to, which I would definitely put on the webinar checklist. But I think the webinar checklist should also be for these too, because you should be able to analyze a deal and decide if you think it's something you want to explore more just from this. And this is just a teaser. They're going to slowly release more information, and then eventually they'll do the webinar after they've slowly kind of built that interest. There's going to be soft commits already. I can only imagine how much they've gotten soft commits already for a deal like this, especially with a 16 to 18% average annual return. You guys, that's wicked for a period like this. That means they're basically, like a 20% IRR, give or take. So it's pretty sweet. It's a sweet deal. So again, to kind of piggyback off yesterday, this is why it's important to get on a lot of lists and look at a lot of deals, go to a lot of webinars, because you're able to dissect and look at stuff like this and know that, it doesn't take a lot to know the 3.8% interest in the current conditions is incredible. But, that's, looking at this and understanding, okay, they're assuming it. The question I have is how they got 7 years interest only. That's negotiated now. What could be the case, what very well could be the case, and this is pure speculation, what could be the case is this could be distress in the sense of no, because if they had a 3%, they had 3.8% interest, and they were not under hot water for these deals, which is why they're selling them, because they probably have floating rate, some kind of bridge on other deals, and those have gone up. And so they need to recapitalize. And how do you recapitalize? Well, typically you're going to sell other assets in your portfolio, try to get a premium. Obviously last year at the $135 million mark, never sold. But this is probably something that they, meaning Open Door Capital and partners, like this has probably been in the works for a few months now, I would imagine, if not even started last year with the negotiation. Right, it was probably brought to them and then they turned it down, or they put in a lowball offer and it was turned down. And then the brokers came back and were like, okay, we're going to accept your offer. Right. And it's going to be subject to even, right? So it's going to be a lowball offer subject to, meaning subject to the ability to assume the loan. So very interesting. So again, you guys, this is why it's important to be on a lot of lists and attend a lot of webinars, because then you're really able to dissect and understand when a good deal is a good deal, why it's a good deal, why it might not be a good deal, right? As you start to look at these deals, especially when you start to look in the same marketplaces and you see all these different return economics and debt structures, you're really able to understand how the market and what kind of growth is actually happening in the market in terms of job growth and economic growth, infrastructure, all the way down to wage growth and then more specifically rent growth. And once you can understand those, then you can really pick apart these deals and be like, okay, once you're able to look at their underwriting, their pro forma, you're like, okay, were they really being conservative here with their assumptions, or is this aggressive and you caught something? And then you go to the webinar and then you're prepared with a question, and they're going to break down their underwriting and the pro forma, but you should be able to ask for, what did they assume there? And they'll show you, right? Oh, we believe rent's going to go up this much. But be careful, because they might be showing you what, again, the assumptions can be manipulated. Those numbers can be manipulated. So you have to be careful with pro formas, because they can be very manipulated, right? So pay attention. Are they telling you, are they using the year 5 rents as to what they're going to get in year 2, right? So little things like that to pay attention to. And the more deals you look at, the more webinars you attend, the more lists you're on, the better prepared you're going to be to when you can finally pull the trigger, and or to really understanding what's a good deal and what's not a good deal. So there you go. Hope you guys enjoyed this. I really appreciate you guys listening. As always, you're amazing. Follow me on social media at Jonny Cattani, Jonny with no H. Join my list, investwithcattani.com. Very, very grateful for you guys. And I will talk to you tomorrow. Have a great day. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CattaniCapitalGroup.com to learn more.